Welcome to this explainer. Today, we're diving into a real masterclass on decoding market psychology. We're going to completely demystify the Fibonacci framework. It's a highly structured, institutional-grade tool, and I'm going to show you exactly how to apply it for absolute precision trading. Let's get right into it.
So, to really understand this, we've got to ask a kind of crazy question. Why does a math puzzle about breeding rabbits from way back in 1202 hold the key to modern Forex and gold trading? Well, back in the 12th century, Leonardo of Pisa, who we all know as Fibonacci, stumbled onto a sequence of numbers where each number is just the sum of the two before it. 0, 1, 1, 2, 3, 5, 8, and so on. But here's the wild part. Hidden right inside this simple ancient sequence is a powerful ratio that translates literally directly to our financial markets today.
And the craziest thing is, we see these exact same mathematical sequences everywhere in nature. Seriously, look around. From the specific number of petals on a daisy or lily to that perfect spiral of a nautilus shell, right down to branching trees, pine cones, and even the proportions of the human body. What this proves is that markets aren't just magic, they're natural systems of human behavior. And human behavior, well, it follows natural, highly predictable patterns. Here's our blueprint for today's explainer. We'll kick things off with nature's market grid, move right into core ratios and retracement phases, and then do a step-by-step drawing tutorial. After that, we'll cover the institutional edge using COT data, break down Confluence and triggers, and finish up by fixing some common drawing mistakes. All right, Section 1, Nature's Market Grid. Let's establish those foundational numbers that make up this whole framework. Okay, I want you to focus on this specific number, 1.618. This is the golden ratio. If you take any number in the Fibonacci sequence and divide it by the one right before it, it approaches this exact specific ratio. Now, in trading, its inverse, 61.8%, is absolutely crucial. It's the specific mathematical harmony that dictates where literally millions of traders are placing their orders. And because so many eyes are glued to these exact levels, it creates this highly tradable, self-fulfilling prophecy right on your charts. Moving on to Section 2, Core Ratios in Retracement Phases. Now we're going to break down exactly how we categorize these core ratios into different phases of market retracements. Before we even think about touching a chart, we have to understand the language of price action, right? Every single trend out there has two alternating movements. What we're specifically looking to measure is the impulse move. This is that big, aggressive, directional price movement that basically establishes the trend, and we measure this directly from one swing point to the other. Those swing points are just the absolute peaks or troughs in the price, the absolute definitive highs and lows. To put this into perspective, think of the market movement cycle like this. Imagine you're taking 100 aggressive steps up a really steep hill. That's your impulse move, right? But then you're exhausted. You need to rest, so you slide exactly 62 steps back down the hill. That 62-step slide, that perfectly represents our 61.8% Fibonacci retracement phase before you can catch your breath and start walking back up that hill. So, the whole trick here is knowing exactly which zone you're currently in. You've got the shallow zone from 23.6 to 38.2%, which means it's a super strong trend where eager buyers are just jumping on small dips. Then there's the deep zone, down at 78.6 to 100%. That's maximum risk. It's kind of your last chance before the whole trend is erased. But the absolute holy grail? That's the golden zone, right at 50 to 61.8%. It's the halfway pause, the ultimate last discount for smart money. In fact, over the last 20 years, this has been the single most common reversal point in gold. No joke. All right, Section 3, Step-by-Step Drawing Tutorial. Let's actually get into the mechanics of this thing and see exactly how to draw this tool on a live chart without, making a total mess of it. Okay, here's your absolute golden rule for anchoring the Fibonacci tool. You must always draw from left to right, matching the direction of time. Simple, right? First, you identify your recent clear impulse move. Second, you anchor your very first click on the absolute leftmost starting swing point. Then third, drag your cursor right over to the ending swing point. And here's the kicker, the detail everyone messes up. You have to click on the exact candlestick wicks, not the bodies, the wicks. That gives you maximum precision. Being just a few pixels off can literally shift your levels by several dollars. Finally, step 4, just read the levels that pop up to spot potential support and resistance. So let's translate this theory into actual reality. Think about a standard 4-hour chart setup. You start at the bottom, anchored right on that absolute extreme wick, and then drag it all the way up to the top extreme wick. Now watch what happens when the price pulls back.
Boom! It hits the retracement level perfectly, giving us a textbook entry on a higher low, totally confirmed by a strong bullish engulfing candle. That right there is the hidden grid in action.
Section 4. The institutional edge, using COT data. Now listen closely, because Fibonacci alone, it's just not enough. That's exactly why retail traders often hover around a 55 to 60% win rate. To really level up, we need to filter our technicals with actual structural market data from the institutions. As a commodities analyst, my go-to is the commitments of traders, or COT data, to confirm these Fibonacci levels. Basically, if the COT data shows that smart money is aggressively shorting the market, while a 61.8% support level in an uptrend is highly likely to break. The structural positioning is totally opposing the bounce. This confirmation matrix is a real game changer. It doesn't just tell you when to take a strong buy or a strong sell. More importantly, it tells you when to just step away, sit on your hands, and avoid a losing trade.
On to Section 5, Confluence in Triggers. So once that institutional data beautifully aligns with your Fibonacci grid, we still need specific visual triggers to actually execute the trade.
Here's the deal. Fibonacci's great because it tells you exactly where to trade. But these specific, high-quality candlestick patterns forming directly on those retracement lines, they tell you exactly when to pull the trigger. If you see a low-quality, messy candle at a Fibonacci level, just wait, skip it. But if you spot a massive bullish engulfing candle or a perfect hammer forming exactly on that 61.8% line, man, that is your signal to go.
And this brings us to building visual confluence. This is how you turn a basic trade setup into an absolute fortress. We do this by making sure our Fibonacci percentages align perfectly with other major technical factors. I'm talking about the volume profile point of control, the value area highs and lows, or those short, intermediate, and long-term moving averages. If your 61.8% level perfectly overlaps with a high volume node and sits right smack on the 50-period moving average, your probability of a successful reversal just absolutely skyrockets.
Check out how this confluence plays out on a shorter time frame, like a 30-minute chart. The price comes down, hitting that deep 76.4% retracement level, and look what forms. A beautiful morning star pattern right on the dock. That's your rock-solid entry. And then, as the price rallies up perfectly to the 161.8% extension level, well, that extension becomes your exact precision profit target. It's beautiful when it all lines up.
All right, we've made it to Section 6, Fixing Common Mistakes. To wrap up this masterclass, let's do some troubleshooting and clear out the absolute chaos that usually plagues beginner retail traders.
There are 4 massive drawing mistakes you have got to avoid. Number 1, drawing from minor, incorrect swing points instead of the true, absolute extremes. Number 2, creating this crazy spider web on your chart by using too many overlapping Fibonacci levels. Seriously, clean it up and delete your old drawings. Number 3, blindly trading every single level that price touches without checking your data matrix. And number 4, this is a big one, ignoring the time frame hierarchy. You can't ever treat a 15-minute Fibonacci level with the same respect as a major daily structural level. It just doesn't work.
So, to fix all this and adjust for maximum precision, we have to look at the wrong way versus the right way. The wrong way is zooming way too close into a chart, drawing random points and taking every little bounce you see. The right way? You always start mapping your grid on the daily chart first to find those major, clean impulse moves and structural levels. Filter that with your institutional COT data. Only then, after all that, do you zoom into the 4-hour or 1-hour time frame strictly to refine your entries around those bigger daily levels.
Just remember this. The grid is always there, but your discipline provides the execution. The hidden grid is always operating on your chart, whether you take the time to draw it or not. The market respects these natural levels purely because millions of other traders are watching them. The market is definitely going to provide the setups, but ultimately, it's your patience, your strict filtering, and your execution that gives you the edge. Well, I really hope this explainer has completely transformed how you view your price charts. You now have the exact blueprint to draw properly, filter with real institutional data, and target absolute precision entries and exits. So here's my question for you. Will you keep trading the random noise, or are you ready to finally execute on nature's hidden grid?